Are you someone who recently started to rent out your real estate and you're not really sure what you're allowed to write off? Well, in today's video, I'm going to be giving you 10 rental write-offs, and you'd be surprised at how many of these are missed and not being talked about. In the video, I'm also going to be touching lightly on GST and HST considerations, depreciation, and towards the end of the video, I'm actually going to show you a live demo on how I track rental income and expenses so that tax time is a breeze. It's a spreadsheet I built myself, which is actually available for free download in the description box below if you want a copy. So make sure you stay until the end for more. Hi, welcome to my channel. My name is Irene, and I post videos explaining important accounting concepts using simple language to help Canadians better understand accounting and taxes. Make sure you hit that like and subscribe button for more. So before we get started, I want to preface the video by saying that CRA has guidance where they say that you are allowed to deduct any reasonable rental expenses you incur in order to generate rental income. The keywords here are reasonable, and it has to be as part of generating rental income, right? So you have to be responsible for keeping the receipts for 6 years in case CRA comes asking for the support. All right, let's get into it. So the first write-off is interest paid on the mortgage of the rental property, or interest paid on any debt that you took on in order to acquire the rental property. So typically when you pay interest on debt that you took out in order to acquire an asset that will help you generate income, that is viewed as cost of borrowing, and so that is deductible expense. Please note that the principal portion of the loan, the debt, or the mortgage, those cannot be deducted from your rental income on your tax return because that is just a repayment of debt rather than a cost of borrowing. So the next write-off is insurance, more specifically property insurance on the rental property. Typically, life insurance premiums paid are not tax deductible, and so in order for you to even write off life insurance premiums, there are a set of criteria that you have to meet for a rental property, and even then, you're only able to deduct a portion of the cost, but that is outside the scope of today's video. So the next expense that can be written off is professional fees. So this includes accounting fees and legal fees. And the legal fees that can be expensed includes the ones where you incur the legal fees in order to collect outstanding rents. I hope you are never in that position. And now you might be wondering, if you recall, when you purchased the rental property, you had to incur some legal fees to close on the property, right? And so those legal fees actually cannot be expensed on your tax return. Instead, these legal fees get capitalized. And what capitalized means that the legal fees will get added to the cost of your property. So let me give you an example. Let's say you bought a condo here in Vancouver for $700,000. At the time you closed, you had to pay your lawyers $2,000 for closing of the property. So now the cost of your property is not $700,000. Instead, it's $702,000 because you're adding the legal fees. So now later down the line, when you go to sell your property, let's say in a few years or whatever, you sell it for $800,000. Now, in order to calculate your gain, you do 800 minus 702 rather than 700,000, okay? So those are capitalized because it's part of the cost of the property rather than an expense in the current period or current year. So the next expense is property taxes. So the property taxes that you pay, you are able to expense or write that off on your tax return. Please note that property taxes are not to be confused with property transfer taxes, okay? So similarly, property transfer taxes upon closing on the purchase of your rental property, those are also capitalized and cannot be expensed. So going back to our old example, the condo you bought for $700,000, upon closing, your property transfer tax was $15,000. So now the cost of your property is $700,000 plus $15,000 plus the $2,000 legal, right? So now your cost of the property is going to be $717,000, which will be used to calculate the gain or the loss in the future when you go to sell your property. So another expense that can be deducted or written off is strata fees. So if you pay for strata fees for your property, then you can write those off. If you hire a property manager to oversee and overlook your property or properties, then of course you can also write those off as well, because those are incurred and in order to generate your rental income. Another expense that can be written off is travel, but within reason, of course. So for example, let's say you live in Vancouver and you have a rental property on the island in Victoria. For some reason, you have to physically go to Victoria to check up on your rental property, and so you book a ferry ride, and of course the ferry ride can be written off because the purpose of you going to Victoria is to actually check up on your rental property and to do something related to that. So that's an example. Another expense is advertising. So any amounts you pay for paid advertising in order to get your unit rented out, or even a finder's fee, those can be deducted or written off. Next is office expenses, and these are just miscellaneous expenses that you incur in order to, again, run your rental property. So let's say you had to run to Staples to print out the lease agreements, then yeah, of course, you can write those off. Next is utilities like gas, electricity, water, cable, or any of that sort, if it is written that you are, as the landlord, responsible for paying those out of your own pocket. And then another one is landscaping costs. So if you have a detached rental property, so now you have to, hire people to do landscaping, mow the lawn, or like do, the flowers and stuff, then yeah, you can write those off as well too, because it's part of maintaining the rental property. So another category of expenses that can be written off or deducted is repairs and maintenance. And this one's a little bit trickier to wrap your mind around, because you're allowed to write off current expenses. So these are typically minor repair and maintenance expenses. One way to think about it is more like the routine costs that you incur to keep your property in its original condition. So let's say, for example, you have a cleaning team that comes and you pay once a month or pays after every checkout for your Airbnb, then yes, of course, those are routine to maintain your property. Another example of a minor repair is that, let's say you decided that you want to replace all of the doorknobs on your property. Typically, these are considered minor because doorknobs don't cost more than $500, as well as they're a pretty quick fix just to maintain the property. So now where it gets a little bit tricky to wrap your mind around is that, yeah, sometimes you're gonna have to spend money to make major repairs or to do renovations on the property itself, or, etc. So those are all considered capital assets and capital expenditures. And what that means is you're not able to fully expense the cost of those expenditures in the year that you purchased it in, because they have a long-lasting benefit. So let me give you an example. Let's say this year you had to replace and buy a new washer and dryer set, and that was $1,500, right? Typically, the new washer and dryer, you plan to use it for at least 5 years, not just only 1 year. So instead of expensing or deducting the $1,500 in the year that you buy it in, what happens is you're going to be taking depreciation on the asset systematically in the next few years to come, right? So for example, your washer dryer, $1,500, right? Because it is at a 20% depreciation rate, you'll be able to take $300 off your income tax return as part of depreciation. And then the next year, you're going to take another $300 off of your tax return as part of depreciation on the washer and dryer, and so on and so forth until the value is totally depreciated. So some capital assets can include furniture and fixtures and major appliances. So for example, couches, TVs, tables, stoves, fridges, washer dryers, etc. And a side note is that if your rental property is operating at a rental loss, let's say your property wasn't fully rented out the whole year, but you still had to pay all the strata, insurance, property taxes, and everything associated with owning the property, and you're at a rental loss, and let's say you also had to replace your washer and dryer for $1,500, right? As I previously said, your depreciation on that would be $300 for the washer and dryer in 1 year, right? But because you're at a rental loss, the Income Tax Act does not allow you to make your rental loss even bigger with depreciation, or CCA is what they call it. And so in that year you have a rental loss, you can't take any depreciation / CCA, okay? But not to worry, if you are in a rental loss, the cost of your capital assets will continue to carry forward into the future years where you can use the depreciation in a year where you have rental profits. So a really important point I want to make here is that you might hear all over the internet is that you can take depreciation on the building cost of your rental property. Although that is true, you can. Depending on your personal circumstances, it might not actually be a good idea for you. So let's say, for example, you personally own the rental property, right? Not through a holding company, but you personally own it. And down the line, you think, hey, maybe I'm gonna want to move into my rental property and make it my principal residence, right? So super out of the scope of today's video, but I just wanted to high level go over it. But basically, when there is a change of use in your property, there is going to be like a deemed disposition. And the Income Tax Act has these special elections that you can make in order to help reduce some of the tax consequences of that. And so if you were to have ever taken depreciation on the building cost of your property, then that will disqualify you from being able to use the special elections that will help you with that, right? So it's really important to consult with your tax accountant, a CPA, so that you know you're better planning for the future and you're not going to inadvertently do something bad in the current moment just because like you heard something online. But mind you, you can take depreciation on other assets. That's no problem. It's only when you take depreciation on the building itself of your rental property. So now I'll quickly go over GST and HST considerations. If the rent that you collect is on long-term residential rent, then those will not be subject to GST, HST. However, if the rent that you collect is from short-term rentals or commercial rentals, then those will be subject to GST/HST after you've reached the GST/HST thresholds. So if you own the rental property personally under your name, you're going to report the rental income and expenses on your personal tax return on Form T776. If you are owning the rental property through a corporation, like a holding company, then the rental income and expenses will be reported on the corporate tax return. All right, it's time now. Let's jump into my computer and I'm going to show you how to do rental income and expense tracking the right way so that tax season is a breeze. So here is the spreadsheet. There are 3 tabs. First one down here is instructions. Second one is transactions, which you're going to be mostly working on. And then third one is a summary for taxes. Before we get started, each spreadsheet is used to track one rental property. Okay. If you have more than one rental property, please make copies of this spreadsheet and track each rental property separately. I would suggest you type in the rental property address right here so that you don't get mixed up. Okay, so let's get started. So basically, over here, there is money in, money out columns, okay? For each time there's a transaction, you have to write a description and you have to categorize it and you have to make an amount because everything you enter in here and the way you've categorized it, it will automatically pull into this summary spreadsheet here. So in this column D down here, it's gonna all automatically aggregate or like total up all the amounts that you entered in from the transaction spreadsheet. So let's give it a try here. Okay, so money in, let's say rent, month is January. So I'll do January, and then money in, money out. The amount is going to be, category is going to be rent collected, other income, or security deposit. So let's say it was rent, let's say it was 35. And then next one is, let's say it was also a new tenant. So we got a deposit, January, and then we'll do security deposit. Let's do half of that. Okay. So if you look back here in the summary page, which is all automatically populated, you'll see that rent was 35, security deposit was 17.5, which is exactly what we've entered. But if for some reason you did rent and you didn't select the category and you did 35, it's not going to show up here, okay? So there's only one rent collected here, but you meant to do 2. You have to select the category. So now that there's rent collected, you'll see it's 7,000. Perfect. So on the right side, it's going to be money going out. So every time you spend money, you're going to have to write this in. The categories are the expenses at the top and capital assets at the bottom, which is what we've already went over. So let's give this a try. Let's say we have strata, we have mortgage, interest, January, and then we'll do management and admin. And let's say strata is $600. And then we'll do Jan, we'll do interest,
and then we'll do, let's say it's 950, okay? So over here, again, the summary page, now you're gonna see the interest portion and then the strata for the 1 month, okay? So let's continue filling this out. Typically rent is same month over month. So all you have to do is just basically change this, the month, because yeah, rent's the same. Now we're gonna do the expenses here. Let's say it's Feb now. Our principal, our interest went down a little bit. And then let's say we had to pay for property taxes. That's what we got to do here in Van. The one time is Feb. And then the next one is insurance. So you have to do the categories, remember, okay? So property taxes, let's say it's 1,200. Insurance, you gotta categorize it, 900 bucks. Perfect. If I go back to the summary page, again, everything is automatically populated. You'll see now our strata is 1,200 bucks. So it was the 2 months combined. Property taxes, insurance, you have rent of 14,000. You see how that goes, right? And so if you were to buy a TV, a capital asset, remember, let's say now you're gonna have to select, let's say furniture and fixtures, 1,500 bucks. So over here, you're gonna see capital assets, furniture right here. And so this spreadsheet here, basically everything is automatically populated. The white cells are for you to fill out, okay? So typically if you purchase capital assets, I would highly recommend you make a comment here saying that you bought a TV, because this is what you're gonna give your CPA, your accountant, your taxpayer at the end of the year for tax time. They're gonna input the amounts on the summary into the respective tax return amounts, okay? And because some of these things aren't taxable, or some of these things need depreciation, etc., etc. This is just a summary for them, okay? And so if you are somebody who personally owns the rental property and you're going to be reporting the rental income on your personal taxes, it's going to be on form T776. So you're going to have to fill out these questions here for your accountant. Otherwise, they're just going to ask you. If you are owning the rental property through a corporation, like a holding company, then you don't need to fill this out, just because the T2, the corporate tax return, is something separate. So you could just ignore that. But basically, this whole summary here, you're going to give the your CPA, your accountant, whomever, this at the end of the year. And again, one spreadsheet is for one property. If you have more than one rental, then please use separate spreadsheets to combine it all, okay?
So I hope you found today's video helpful. Again, a copy of the spreadsheet can be downloaded for free in the description box below. Thank you so much for making your way until the end of the video. Make sure you hit that like and subscribe button for more. Over here, YouTube thinks that you're gonna really like this video, so I'll meet you there. Thanks!